estate planning for principals of private equity and hedge funds. That's the subject of today's Actec Trust and Estate Talk.
Welcome to Actec Trust and Estate Talk from the American College of Trust and Estate Counsel, a professional society of peer-elected trust and estate lawyers in the United States and around the globe. This series offers professionals best practice advice, insights, and commentary on subjects that affect our profession and clients. And now, our Actec Fellow host with today's topic.
This is Natalie Perry, Actec Fellow from Chicago, Illinois. Actec Fellow Marissa Dungy from Greenwich, Connecticut, will share her thoughts on what principals need to keep in mind regarding carried interest of private equity and hedge funds. Welcome, Marissa.
Great. Thank you, Natalie. I'm happy to be here today to talk about carry planning for hedge fund and private equity principals. My plan is to take you through my approach when I have a client interested in planning with their carried interest. First off, what do I mean when I say carry planning? Carried interest, or sometimes called a promote or incentive fee, and an interest in the profit earned on someone else's capital. So in a typical hedge fund or private equity structure, third-party investors or limited partners will contribute capital to a fund, and the fund will pay a management fee to a management company based on AUM, so 1 or 2% to cover operating expenses. And then there's a general partner. The GP receives the incentive fee allocation. For example, 20% on the profits of the fund, often after a threshold rate of return is achieved for the limited partners. And so from a planning perspective, carry is a really ideal asset to plan with because as a profits interest, it's necessarily not worth much in the beginning because you haven't actually earned the profits yet, and not especially with the potential threshold rate of return. So you have very limited value up front, but potentially exponential upside. The complicating or a complicating factor is that the general partner or the principals individually are expected to have skin in the game and invest their own capital. And it's the existence of these two types of equity that make carry planning complicated because it implicates Section 2701 of the tax code. So 2701 applies its own valuation rules to transfers of an interest in a closely held business where there's more than one type of equity, in this case, capital and carry, from a senior generation family member to a member of that transferor's family, typically a child or a trust for the benefit of the child, where the transferor or an applicable family member holds an applicable retained interest after the transfer. It's kind of a mouthful. Break it down quickly. First, the transfers is not just gift planning. It could apply where the transfers is for full and adequate considerations, without taking into account the valuation rules of 2701. So a sale, for example. The section is aimed at this kind of senior generation family member to a member of the transferor's family. The section is aimed at preventing perceived abuses where senior family members are shifting value to junior family members through kind of artificial means. So certainly not the hedge fund or private equity structure, but nonetheless, the section is broad enough to kind of capture that. So applicable retained interest, so what is the interest that you have to hold on to? There's two different types. One is this extraordinary payment right, and those are kind of like bells and whistles where the senior generation has, for example, rights to non-cumulative dividends or rights to kind of discretionary that they may or may not exercise, and in a family context are kind of assumed to not exercise so as to benefit the other stakeholders. That's not really the issue in the fund interest. It's really this separate idea of a distribution right. A distribution right is just basically the right to receive distributions with respect to an equity interest. Really broad, necessarily includes your right to a profits interest, your right to earnings on an equity interest. It only applies where there's control. So one is, if you have a principal who owns the general partner, necessarily you have control. It's kind of a given in the fund context. And interestingly, the way they define control basically says, more than 50% of the capital or profits interest or any equity interest as a general partner. And in a fund context, usually what you have is a general partner. And so there is an open question as to whether or not general partner includes just being the general partner or an interest in the general partner. But with that kind of ambiguity out there, because there's a general partner in the fund context, we assume we're in we've met the control requirement. And there are certain things, again, kind of keeping with the idea that these are discretionary rights that a person might have that could easily be shifted to a different interest. There are certain things that are not considered distribution rights. Rights to guaranteed payment, mandatory payment rights. This idea of you are required to get X. And that includes, in this context, liquidation participation rights. This idea that a distribution right where you can get back your capital is not going to be considered a distribution right for these purposes. And remember, what we're valuing is the value of the distribution rights. That's the impact of 2701 is, okay, what are the value of the applicable retained interest, or what are the value of the distribution rights? And the consequence of coming under 2701 is that those applicable retained interests, or that distribution right, could be valued at zero. In the fund context, if you're going to make a gift and hold on to a portion of your carry or capital interest, to make a gift of it, if your interest that you retain is going to be valued at zero, that could be a substantially larger gift than you'd intended on making in the first instance. So you really do have to pay attention to 2701 when you're doing fund planning. There are certain exceptions, ways to plan that we know are not going to trigger 2701 in the fund context. One is the idea of the same class. We know that if you give the same thing that you have, and that's all you have, then we know that you're not going to get 2701 because you and what you gave are the exact same interest. There's no way to kind of shift value from one interest to the other. And so in the fund context, this is usually achieved by using a holding company or family limited partnership, or family limited liability company that can hold your carry and your capital in the same vehicle, and then you gift or you do another transfer with respect to the LLC interest. And then you haven't, conceivably you haven't actually transferred. You don't have two different types of equity. You just have one. You have that LLC interest at the top. So that's one way that 2701, even though there's multiple equity interests at the bottom, you're not going to be affected by the valuation rules of 2701. The other is this concept of proportionate transfers, what we all call a vertical slice exception or vertical slice rule. This idea that if the transfer results in a proportionate reduction of your interest then we're not going to apply 2701, because we know if you transfer 20% of your capital and 20% of your carry, there's no way to really artificially shift value from one to the other, because you both hold, I continue to own, or the principal continues to own 80% of his interest in both. The transferee owns 20% of their interest. You can't, if you're going to shift value from the capital to the carry, then, you're both going to get the same benefit. You're not shifting value if you do a proportionate interest. And so vertical slice planning is probably the most common way that people plan with carried interest. In terms of the types of planning vehicles that you could use, for various reasons, GRATs are often not the planning vehicle, and they're a very popular planning vehicle on their own. They often don't work well in the fund context. And part of the reason for that is that, as we know with GRATs, you can only put in one contribution. You cannot make additional contributions. And so if you're in a new private equity fund, for example, and you've made a capital commitment, all of your capital is not due right away. So you either have to put in cash or, put in cash in order to be able to pay that ongoing capital commitment. You can't add anything later. And GRATs also require that an annuity be paid out on an annual basis. And so where you have a new private equity fund, it's not just the cash flow on the way in, but also the fact that you're not going to be getting distributions for potentially several years before you can make the annuities in cash. And as we all know, you can't loan money back to the grantor in order to meet the annuity requirements. So for some of these cash flow reasons, GRATs really don't work very well. And also because you have to make these constant transfers, unless you actually do have cash, it's the possibility that you're doing another 2701 transfer and attempting to pay the annuity if you had to do so in kind, which is another way of saying that intentionally defective grantor trusts are a very common planning vehicle in this context. And so very frequently, you might see a gift at the outset of a fund is the most ideal time, because that's when the profits interest is worth the least. But you could, in theory, do it at any time. I would say about GRATs is that if you are in a private equity fund and you're at the later stage of a private equity fund where you're already in a distribution, all the capital's been called, distributions are already happening in cash, and you put that into a GRAT, that's actually not, I do that on, pretty frequently in a later stage of a fund, because I know I'm going to have the distributions to make the annuity payments, and I already have a lot of value because I'm into the fund. I have a sense of what the profits interests are going to be. And, that's a bigger risk type thing than if I'm at a brand new private equity fund. I have a commitment of $1 million and I have a profits interest on top of that. While I do have the gift component of the $1 million capital, the carry's not worth a whole lot at the outset because we don't know yet what the profits interest is going to be. It's certainly worth something, but it's at its lowest value at the outset when there's still quite a bit of, a risk and question involved as to whether or not the fund's going to be successful. Finally, I wanted to mention, there's one planning technique that is an attempt to kind of just avoid 2701, which is using derivatives to not make a transfer. By using a derivative, you can kind of mirror the benefits of what you would get without actually transferring the carry or the capital. And so that's become a more common technique, most notably with fellow David Handler. And so, that I think it is Definitely you want to be conscientious of 2701 when you're doing carry planning. As I always say, gift early and gift often, and carry is a great asset to be planning with. So thank you, and I'll turn it back to you, Natalie.
Thank you so much, Marissa. That was really informative. We always enjoy learning a little bit more about planning for principals in private equity and hedge funds.
Thank you for listening to this episode of Actec Trust and Estate Talk, the podcast series about wealth planning matters from the American College of Trust and Estate Counsel. To find an Actec lawyer near you, visit actec.org. Please subscribe to this series and leave us a rating or a review. Follow us on Facebook and Twitter at Actec Talk.